You bought Apple stock, and now think Tim Cook's inviting you to dinner? Cute. You don't own Apple. You own 0.0000001% of hope and vibes. Welcome to the stock market, where millionaires are made, and everyone's pretending they read the earnings report. Stocks sound sexy. Just invest, they say, like it's a cheat code for retiring at 30. But let's be honest, most people don't even know what they're buying. Is it value or just vibes in a hoodie? So today, we're breaking down what a stock really is, why companies sell them, and how not to get rug pulled by Wall Street. What even is a stock? A stock is ownership, not vibes, not lottery tickets. When you buy a stock, you own a fractional piece of a company, not the whole thing. You're not strolling into Nike headquarters to rearrange the sneakers. You own shares, tiny units of equity. Think of it like this. Shares are the slices. Stock is the pizza. Equity. That's just the fact that you own pizza. And that ownership gives you two things. 1. A claim on profits. Dividends if the company feels generous. 2. A vote on company decisions, unless you bought the shut up and hold kind. More on that later. Let's go local. A pizza shop splits into 10 shares. You own one? You're now 10% pizza boss. If the shop blows up, your slice gets tastier. If it flops, your cheese melts with it. Why do companies sell stocks? Short answer, they want your money. Long answer, they want your money, without kissing the bank's ring or calling grandma for a loan. Raising capital through stock means getting cash without debt. They issue shares. You buy them. They build stuff. And hopefully, what they build makes your little investment grow into something big. What do they use your money for? Expanding, hiring, paying off debt, or buying their competitor's soul? You know, the usual. Let's go back to Sarah. She wants to open a pizza shop. She's got 50 grand, but needs 100. So she slices the business into 10 shares, sells 5, and boom, she's funded. You didn't just invest, you bought the oven. Fast forward to big tech. Facebook bought Instagram, not for selfies, but for mobile dominance and your data. Now it's a billion-user monster. NVIDIA started by making GPUs for gamers. Then AI exploded. Now they sell the brains behind ChatGPT-level tech. Amazon sold books, then built warehouses, then leased planes. Now it owns your shopping habits. None of them begged for loans. They sold stock, and people who believed in the vision, they didn't just make money. They backed empires. Two main types of stocks. Let's keep it simple. There are two main breeds of stock in this financial zoo. Common stock. This is what most people buy. You get voting rights. Yes, Karen, you can vote on who sits on the board. Dividends. If the company feels cute. Potential high returns, along with potential high blood pressure. But here's the catch. If the company crashes, you're last in line, after the debt, after preferred shareholders, after the janitors, after the office goldfish. Preferred stock. Less sexy, more chill. You don't vote, you don't get drama. But you do get fixed dividends, like clockwork, until they don't. Priority payouts. You eat before the commoners if the ship sinks. Less price action, but also less potential upside. Think of it as the boring rich cousin of common stock. Doesn't show off, just quietly collects checks. How stocks make you money. Stocks pay you in two ways. Number 1, capital gains. Buy low, sell high. Sounds easy. Then your emotions show up wearing Crocs and ruin everything. Ask anyone who panic sold Tesla at the bottom. It's over, they screamed, right before it 10x'd. Number 2, dividends. When companies make money and feel generous, they cut you a slice. It's like a tip, but for just existing. Not every company pays them. Some reinvest the profits, which often means ping-pong tables and kombucha fridges. Let's get real with numbers. Say you dropped $5,000 20 years ago into Apple. That'd be nearly $900,000 today. Roughly 29.8% annual return. One iPod turned into early retirement. Coca-Cola, slow and steady, decades of dividends, doubled every 10 to 12 years. Not flashy, just dependable. S&P 500 index via SPY. $5,000 becomes about $34,000, around 10.5% per year. And zero drama if you ignored the noise. Bottom line, growth stocks can go beast mode, but they swing harder than your ex's moods. Dividend stocks, they grow like trees. Quiet, predictable, fruit-bearing. And indexes, they're the stress-free, guru-free, Buffett-approved path for most humans. Real performance. Not just hype. Let's be real. Over the long run, stocks outperform almost everything. Why? Because companies grow, and stock prices ride that wave. Add in inflation protection and compounding magic, and your money starts snowballing like it's in a Rocky montage. Put $100,000 into QQQ, the NASDAQ 100, back in 2004. You'd be sitting on nearly $1 million today. That's not guru hype. That's math, powered by Apple, Nvidia, and friends. Meanwhile, bonds, snooze, cash, eaten alive by inflation. NFTs? Let's not even start. Sure, stocks are volatile, but they're also growth engines. You're buying into companies that invent, build, sell, and scale. Real businesses, real value. Stocks aren't your only option, but they've got the best track record for turning belief into wealth. It's not gambling, it's owning pieces of the economy. Yes, so it's a roller coaster. But the seatbelt, it's called diversification. Where this all happens, stocks live on exchanges. The New York Stock Exchange, NASDAQ, TSX, and a bunch more acronyms pretending to sound important. Back in the day, it was a sweaty room full of guys yelling into phones. Now, it's just algorithms yelling at each other in nanoseconds. You don't need a broker in a fancy suit anymore. You need a thumb and an app. Click. Buy. Pray. Buyers? They want in before the next boom. Sellers? They want out before the next bust. And the price? It dances. It goes up when people are greedy. It drops when fear hits the timeline. It's part business, part emotion, and part TikTok hype cycle. Welcome to the market, where logic checks out and vibes take over. Indexes. The scoreboards that everyone pretends to understand. You've heard of the S&P 500, Dow Jones, NASDAQ. They're not companies. They're collections of companies. Think of them like playlists. But for stocks, S&P 500, that's 500 of the biggest U.S. companies. Dow? Just 30 old-school blue chips. NASDAQ? All tech, all the time. When the news says the market is up, they're usually talking about these indexes. But remember, the market going up doesn't mean you're getting richer. It just means someone is. Warren Buffett's index tip. Buffett says, if you don't understand stocks, don't fake it. Instead, buy a low-cost S&P 500 index fund. Then chill. Let America do its thing. And Buffett didn't just say that. He bet on it. In 2007, he put $1 million on the line. He bet that a boring S&P 500 index fund would beat 5 elite hedge funds over 10 years. The hedge funds had fees, suits, and spreadsheets. Buffett had patience and a 0.04% expense ratio. By 2017, Buffett's fund returned 125.8%. The hedge funds? Just 36.3%. Wall Street got wrecked by simplicity. And the best part? He donated the winnings, $2.2 million, to a charity for girls in Omaha. Now, Recap time. Owning stock doesn't mean you run the company. It means you're betting on it. Profits, growth, and maybe a little luck. Some companies will fail. Some will fly. But real wealth? It's built with boring, dividend-dropping, profit-chasing stocks. Not with magic, with business. And no, buying Starbucks stock doesn't mean your Frappuccino is free. Nice try. So hit that subscribe button and learn to buy businesses, not just tickers and vibes. We've got more no-fluff, fun takes on personal finance, investing, and building a smarter life. No yachts, no gurus, no magic. Just real talk. See you in the next one.